How to Trade Forex Lecture 20, and in this lecture we're going to look at how to defend trades when things go wrong, and surely sometimes they will go wrong. So the lecture looks at the theory behind how we defend trades. In a later lecture we'll look at some practical examples. Okay everybody, so we're now going to talk about defending trades that go wrong. This is probably the most difficult part of the training to understand, but that's fine because it's probably also the most difficult thing to understand in the whole world of trading and investing. And I'm going to look at three defense techniques in this program. These are the three that I've probably only ever used. There may well be others, but these should match just about every set of circumstance that you come across. I would say in advance that I can't possibly put into any training program, nobody can, every set of circumstances that requires defending. And therefore you might have to do some thinking, you might have to do some bending and some innovation. But I am always available for you to contact, to ask me questions on how can I do, what are my options on defending a particular trade. I'm very, very happy to do that. So the first type of defense I'm going to talk about might surprise you. It's the stop-loss defense. And the reason it might surprise you is because whenever I've mentioned it in the program so far, I've always finished with a statement saying, but I don't use it. And that sounds almost like I don't use it and I don't like it. But that's not quite true. There are definitely circumstances when the stop-loss defense is appropriate. It's not very frequently appropriate to the type of trading that I do, which generally is quite slow-paced, slow, methodical, safe. If, however, I was trading on a fast and furious basis, scalping and taking very quick trades, very quick profits, and lots of trading, then I'm sure I would probably use the stop-loss defense more frequently than I would ever do it now. So here's how it works. So we start off, we're in a position, we have an open buy trade for this example, and we would set a stop-loss order probably at the same time as we entered the buy trade. And we would have to choose where to put the stop-loss order. It could be anywhere below the buy trade. It could be very close to the buy trade, it could be a long way from it. Where you place this stop-loss order really does depend on lots of factors. It could be, for example, a function of how much is in your account, how much equity you have. It could be a question of your propensity for accepting risk. It could be looking at the charts and seeing where you think there's good support and just getting underneath it, for example. That's certainly one that I would use. But when you take all those factors into account, it comes down to deciding how much of a loss you would be prepared to take on this trade. For the sake of this example, I'm going to say that the maximum loss that we would be prepared to accept is £50. And then I can work out how many pips below the buy trade I need to put the stop-loss order for it to cost me £50 or so if the thing went wrong and the stop-loss order had to come into play. So we're into our buy trade, we've got our stop-loss in order, and all is well. We've got our first candlestick there, we're in profit on the buy trade, hooray, fantastic. And again, the next candlestick keeps us in profit. Happy days, no problem whatsoever. Unfortunately, things then turn round, and we get a nice long candlestick that takes us into a loss-making situation. Now, that's not triggering the stop-loss order. Things may turn round and go back up. We certainly hope that they do. However, if that doesn't happen, and the next candlesticks continue to take us down, it would trigger our stop-loss order. That would be the end of the game for this particular trade. We would have entered this buy trade, we would have decided how much pain we're prepared to take on it, put our stop-loss order in place, and lo and behold, trade goes against us, and we have realised a £50 loss. The idea from people that use stop losses a lot is that they would take profit more frequently than they would take losses, and they would take bigger profits compared to the size of the losses they would take on each occasion. And that's a perfectly legitimate strategy. It's just not one that I normally use myself. Of course, the example that we've used here is of a buy trade, and the stop loss order defense mechanism works in exactly the same way for a sell trade. Obviously, if we're using a sell trade, the stop loss order would go above at a higher price than the sell trade that we place. But other than that being what you might call upside down, everything else is the same. So moving on, the second type of defense I want to consider is the equal and opposite defense. Now this is a defense mechanism that I had to think through and develop for myself. I didn't come across this on any training course. I didn't come across this on any website, in any book, in any article. I had to work out the rules on this for myself, and I've used it very successfully. Thankfully, I don't have to use it very often. If we take the live trading experiment from the Forex Trader magazine for the current year, 2014, that experiment started trading in January of 2014 and didn't have to use any defences whatsoever until October of 2014. At that point, we placed a buy trade and the market dropped on news and left our buy trade high and dry and in loss. And at that point, we implemented the equal and opposite defence. And we're still in October in 2014 as I record this, so we're still working on it. But you can certainly look back at the live trading experiment blog on the forextrader.co.uk website and see exactly what happened from here on. So we start in a similar situation. We have a buy trade in existence, and we've got a level of pain that we are prepared to accept. And that level of pain is represented by about the same gap on this diagram, and I put it in as a dotted line. That's where we would have placed the stop loss order. But in this occasion, I'm going to actually put a limit sell order. It's the same volume, volume 1. So what we're saying now is, if the buy trade goes wrong and the price goes down, it will eventually trigger a limit sell order. And I'll be left then with two orders, two actual trades in play, a buy and a sell. So the gap is the same, and the difference is £50, exactly the same as on the stop loss order. So let's see what happens this time. I've got the same candlesticks in play, so we're all happy to start off with, and then we get a downward movement in the price, and another downward movement in the price, and another downward movement in the price. But what happens now is that a limit sell order triggers, and we end up with these two trades in place. But the £50 loss hasn't been realised, it's been stabilised. No matter now what happens, unless we take more action, if the price falls, our loss will stay at £50. If the price goes up, our loss will stay at £50. So let's have a look at that. Here we are, so we've now got the sell trade in place. We've got two trades, a buy and a sell, of equal volume, and the price continues to go down. No matter how far it goes down, so whatever the gap represented by this arrow is, we will have still £50 of loss. The original buy trade is now in loss to the tune of £70, but the second sell trade is in profit to the tune of £20. So that's how come we've stabilised the loss at £50. Had it gone the other way, had the price increased, then again, no matter what the gap, we would have been at £50. The price has gone up, so the buy trade is now in profit at £20, and the sell trade is in loss of £70. So between them, it's a £50 stabilised loss. Now that's great. we haven't realized the loss, but neither have we eliminated any part of it either. So the next part of this technique is exactly that. It's actually how we get out of the trade, and we do that normally by degrees. So not all in one go, but little by little. And this is how we do it. So here we are back in position. We've got our buy and sell trades in trade, and we've got the price rising with a good strong candlestick going up. Now once that candlestick has actually gone up and given me a little bit of leeway above the buy trade, I'm going to put in place a take profit order. The price now needs to come down to take the trigger, or to put the trigger in action for my buy trade. Now that's a strange one, but that's what I'm saying. Now let me just go through that again. Price has gone up, I've let it go up, and then below the current price but above the buy trade, I put a take profit order in. What I'm waiting for is then for the price to fall again. And as it does, it will first take me out of that buy trade. So the old buy trade is now out. I've taken a very small profit on it. What I do now is place a new buy order, also of volume 1. So I'm now left with two orders again, a buy trade and a sell trade, but this time the gap between them has closed. So originally it was £50 and now it's only £30. So we now have the situation where, having had the price move up and let us change the position of our buy trade to reduce the gap to £30, the price has now fallen. So it's a similar technique, it's just again the other way around. So we'll let the price fall well below our existing sell defensive trade. When it gets well below that trade, we put in a take profit order on it and wait then for the price to turn around and to start to go up again. When it does, we'll take the profit on that sell trade, let the price continue to rise, and then put in another new sell trade. In this example, we've now reduced the difference to £10. That could be any figure, of course, and it could even be that the price went up so strongly that we eliminated the need to put in a new sell trade. It just takes the old buy trade into profit, and we get out. So what we've done so far is started with a £50 gap, reduce it to a £30 gap, and then reduce it to a £10 gap. And we could obviously keep going with that. In the example that I've shown, we moved the buy trade and we moved the sell trade. It could be that we just moved only the buy trades or only the sell trades. It depends what happens with the prices. Whichever one we get the opportunity to move, we move to reduce that gap. If we continue that program of moving the trades, then we can logically get to a situation where the two trades are now reversed. So we've got the buy trade below the sell trade, and the sell trade is in profit, and the buy trade is in profit. At that point, we can close them both and walk away very, very happy indeed. So that's the equal and opposite order defense technique. The next defensive technique we're looking at is the double up defense. And this was given to me by one of my trainees, in fact, who's gone on to become a good friend, a guy called Ian Burns. So Ian starts off with a buy trade. Same in this example, it could obviously be a sell trade, and just took the other way around. But for the example, we've got a buy trade of volume 1. Things go as they did before, initially for us, but then we get a problem. Now when the trade starts to go against Ian, what he would do is again make a decision about where he wants to start taking defensive action. But what he would do is not put a stop loss order in and not put an equal and opposite order in, but to put another buy order, a buy limit order in, but this time at twice the volume. Now yes, that is a risky strategy, and as long as things go to plan, we're okay. So let's assume for the moment that things do go to plan and see what happens. So the price continues to fall and the buy limit order is triggered, and we end up now with two buy orders, one of volume 1 and one of volume 2, and both of them currently in loss. Now, if the price turns around and starts to go up, then the buy order with volume 2 goes into profit, and it's got twice as much profit rate of growth as the first order. So there comes a point which is between these two buy orders where it's possible to close both of them and to take an overall profit. So the original buy trade would still be in loss, but the second buy trade would be in profit, and the level of profit that's in would be high enough to actually cover both situations. However, the problem is, of course, that once the second buy trade is triggered, the price could continue to fall, and we've got a very high rate of loss increase. So therefore, this defense technique also needs a backstop, and you'd need to put in place one of the other two, either the stop loss or the equal and opposite order defense in place to act as a backup and to defend the defense. It's still a legitimate way of trading, and I know that Ian has used this many times successfully. I have used it successfully, but it's not one that is going to be my first port of call, and I include it here for the sake of completeness and to give you more options.